Mortgage rates live with the mortgage calculator. We'll get started here in just a minute, just waiting to go live on all the different platforms. We did put the chat up on the screen, so feel free to drop a comment in there while we wait to go live here. A couple people already dropping comments in there. Nicole, Nick, Mark, thank you for tuning in early. Adam dropping a comment there. Thank you. Shout out to the Mortgage Calculator team tuning in. We'll get started here in just a minute. Happy Friday, everyone. Ready for the weekend. It's going to be interesting to see the rates today, right? Lots of stuff going on in the news and the financial news. So we'll see what it's looking like here today. It's probably going to be even more different later this afternoon. All right. Thank you, everybody, for dropping comments that's tuning in. Just give us a minute here to go live on all the different platforms. All right, lots of people commenting there. Ben, Matthew, the other Matthew, Christina, Sonara, Pearl, Jason, Melvin. Thank you, everybody, for tuning in nice and early. And we're about to get started here. All right, it looks like we are live on all the different platforms here, so we can go ahead and get started. We are live on YouTube, Facebook, Instagram, and LinkedIn. So let's go ahead and get into it for today. Welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and some of our favorite loans are what we're going to talk about here today, which are 5 to 8 unit DSCR, one of our most popular products here for our investor clients. We're very excited about these products, and it is something that we specialize in. So we are going to have our sales manager, Jose Gonzalez, with 27 years of experience, do a deep dive into that topic here shortly. But in the meantime, we're going to pull up the actual live rates for today, which we do every day here on this show. So Nick, why don't we go ahead and pull up our pricing tool to see what the market is looking like this morning?
All right. Lots of news coming out, lots of action in the stock markets. So, as Kyle said, we're probably going to see some volatility this morning. Let me go ahead and switch my screens and we can check it out. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR for those rates, which includes all of the costs. If you'd like a full breakdown of all the costs that go into the APR and a full loan estimate with the itemized expenses there, please get with our team. We have over 300 licensed loan officers, and we offer our primary second home loans in 24 states now. And we can do our business purpose, DSCR, which Jose is going to talk about a little bit later, in 44 states, so pretty much all over the US. So again, this is just going to show us our general programs. It is June 2nd, just after 11 a.m. Eastern. Lots of economic announcements. Jobs report just came out a couple minutes ago. Usually the markets are a little bit behind. So since the 10-year spiked this morning, we might not see the positive results yet, but hopefully we can check it out. So as we do every morning, we'll set up a basic loan scenario, 400,000 loan amount, 80% loan to value, 20% down payment. We will tell the computer to find the best rates at one discount point in cost. That is typically our request from our customers, is to buy down the rate a little bit. So that's our typical request. We're going to check out our conforming conventional products. Then we'll compare that to FHA. And then we'll check out our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs with alternative income options. VA is only for our eligible veterans and active service members. If you do happen to be eligible, please let us know. We'd be happy to quote that, but not everybody is eligible, so we don't do that live. And same with USDA. That's only for eligible properties in a USDA eligible area. So if you do happen to be shopping there, please let us know. We can quote that very quickly as well, but not everybody is. So the most common option here, we'll start with conforming conventional. We're going to set up a purchase, 30-year fixed scenario, standard scenario, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all of our demos today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So with these basic settings, as we do every morning, let's check out the conventional rates. All right, looks like about the same as yesterday still. So again, as suspected, a lot of volatility going on. Hopefully in the afternoon, we'll see some more improvement. But this is the same as it was yesterday, I believe. 6.75 rate, 1 discount point in cost, and an APR of 6.917. So remember, we're going to use APR to compare across programs. That includes all the costs of borrowing. So that will allow us to compare apples to apples across our different options. So if our customer has any trouble qualifying for conventional, usually the next option we want to present, set up the same exact scenario, is an FHA program. So next we'll check out our FHA rates. Everything else is going to be exactly the same as our other scenario. That way we can compare apples to apples across the programs. So with the same exact settings, let's see what the FHA rates are this morning. So a little different than yesterday, I think, a slight bit, but right around the same ballpark. 6.125 rate, 0.75 discount points in cost, and the final APR here of 6.709. So as we say every day, APR includes all the costs, and FHA does have additional costs. There is an upfront mortgage insurance and a yearly mortgage insurance. However, with the recent changes, this scenario for this borrower in this situation, FHA is actually a little bit cheaper. So definitely recommend our borrowers out there shopping can compare. If you qualify for both FHA and conventional, definitely compare both options. FHA does allow a little more leniency on credit and DTI. So if you have to do FHA, amazing options now, actually a little bit cheaper than conventional. Now, if for any reason our customer has trouble qualifying for conventional or FHA, many other banks or lenders don't have other options, but that's where we love to come in with our specialty non-QM, aka expanded guidelines options here. So with everything else staying the same, notice we get one new option we can select here for our non-QM, and that's our income verification. So full doc is what we use for FHA and conventional. That's 2 years of tax returns, what everybody's used to. So typically we would choose this option to select one of the other alternative income options. So we have some general ones. The asset related options are awesome. We have some episodes on that. We have business bank statements. We have our investor options we'll talk about in a minute. We have personal bank statement, 12-month, our most popular program for a primary purchase. We have RSU stated, VOE, 1099 P&L, no income at all. But the most popular option here is a personal bank statement, 12-month program. And that's for our self-employed borrowers. So many times our self-employed borrowers with 2 years of tax returns have different write-offs and things that may cause some issues, and they may not qualify at all or may not qualify for as much income as they want. So in this case, these non-QM solutions are amazing because instead of using 2 years of tax returns, we're simply going to use 12 months of bank statements, the last 12 bank statements, and we're going to determine a debt-to-income ratio, in this case of 40%, using the actual cash in the bank rather than the tax returns. So most of our self-employed borrowers qualify where they wouldn't qualify at all or qualify for double, triple, quadruple the income when we're using these methods and can therefore get the home of their dreams. So with these solutions, let's check out our non-QM options today. Remember, these rates are going to be a little bit higher, obviously, because they're a little bit different, but they're very comparable in the market today. So the best option the computer found here, 7.25 rate, 1 discount point in cost, and a final APR of 7.317. So great option here. Remember, conventional was 6.9 something. Here, for not even half a point higher in cost, we can change from conventional, which has a lot of restrictions, to a non-QM program to use bank statements. A lot of other leniencies that are afforded to us here on non-QM. So some of these may allow things like bankruptcies and foreclosures. Probably the options here as we scroll down at the little bit higher prices, a little bit higher rates, will have those features. So please get with our team. They'll find which of these programs will fit best for your scenario and allow you to qualify for your dream home. And before we pass it off to Jose, we always want to do some live pricing on investment properties. So for our final couple demos here, we're going to change the occupancy to investment property. We love to work with investors, whether you're a first-time investor purchasing your first rental property, or you're a seasoned investor with dozens of properties, we have some amazing options. So for our investments, we'll set up the same exact scenario, 80% loan to value, 20% down payment, 99 price. Everything else is going to stay the same. And we're going to compare our two options here, our conforming conventional investment property rates with our non-QM options. Remember, FHA, VA, and USDA are not eligible for investments. So we'll start here with conforming. Everything else will stay the same as it was before. Notice the only thing we've changed here is occupancy. So same settings as all our demos. All we've changed is occupancy to investment. So let's check out the rates this morning. And as we mentioned, every day, the conventional GSEs that operate the conventional programs have added basically penalties for investment properties. So unfortunately, the computer does not find an option for 1 discount point. The best, most affordable option here, the computer found was a 7.25 rate for 3.625 discount points. Pretty hefty out-of-pocket expenditure for our investors there. And a final APR of 7.504. So these options, many of our investors would ask to go up in rate a little bit in order to reduce the discount points, the cash out of pocket, because they'd like to invest in other things. So unfortunately, with those penalties that are added for investment properties for conventional loans, there are no 1 discount point options here. So that's where we love to present our non-QM options here. A lot of other leniencies, but we'll definitely solve the problem of being able to go up in rate. So for the final demo here, we'll set up the same scenario. Investment property, 80% loan to value. And now we'll choose our expanded guidelines, non-QM, so we can choose one of our alternative income options. Now, the most popular option by far, and our most popular product here at the Mortgage Calculator by far, the one we love, and the one Jose is going to talk about in a minute, is our DSCR product. And that's because it doesn't require any income, any employment, any of that from our borrower. We're simply going to use the estimated rental income from the property we're purchasing in this demo to determine a DSCR ratio. That stands for debt service coverage ratio. And what that means is if the estimated rents can cover the PITIA, the expenses of the mortgage we're proposing, that is a DSCR ratio of 1.00 or higher, aka the property cash flows on a monthly basis. If the property does not cash flow on a monthly basis and the rents can not quite cover the monthly expenses, that is a DSCR ratio under 1.00, and we still have options for that. For our live demo, though, I always delete this. That way we can see all the different options pop up. And the final thing we must select is a prepayment penalty. 3 years is standard for all the non-QM investment properties. However, we can select 0 if we wish. That will limit the loan programs. Not all of them allow 0, and that will cost much more. Same thing with 5 years. Not all loan programs allow 5 years. When we do find one that works, that will cost less. But for our demos, we always choose 3 years because that is the most common and will show us the most breadth of options here. So with these basic settings, let's check out the DSCR rates today. So looks good here. Better than it was yesterday. So again, non-QM always surprising us. So now we have 4 options under 8, whereas earlier this week there were 0 options under 8, right? So non-QM has gone down a little bit. Best option here we can find, 7.875 rate, 0.725 discount points and costs, and the final APR of 7.932. So a little bit higher rates here, obviously, for a non-QM program, but very comparable. Remember, conventional was just about 7.5, I believe. Now we're at 7.9, right in the same ballpark here. And we're using a DSCR loan. No income, no employment. Our investors can do multiple loans at the same time because there's no income or employment. We can cash out multiple properties, purchase multiple properties, all kinds of flexibility afforded here. So great options. Most of our investors, because we've also solved the discount point problem, almost the same rate, tons of savings on discount points, so our investor saves cash out of pocket, and a very comparable APR means most of the time, pretty much I'd say about 90% of the time we're doing an investment property purchase for one of our clients, they're going to select the DSCR program. Definitely a lot of flexibility. Please speak with one of our team members so they can explain all the options here. There are a lot of different options. As you can see on this page, there are different DSCR options that we have. If we scroll down, we'll see some different prepayment penalty options. Some of these may allow things like short-term rental income, which we went over an episode on earlier this week. So please get with our team to find which one fits best for your scenario. There are hundreds and hundreds of options for us here. Now we will get into our deep dive with Jose about one of these specific DSCR options, which is a very special version. So let me switch my screen here and present our topic for today. Those of you that joined us earlier, we're going to be talking about 5 to 8 unit properties. So our demo, remember, was just a 1 unit single family home standard scenario. Now we're talking about something totally different. We're talking about a small commercial property where we can still use these amazing DSCR programs, which are very simple, very easy programs to get through. They're not a commercial loan, but they are kind of a hybrid of a commercial loan. So instead of going the traditional commercial route for a 5 to 8 unit property, which is a small commercial property, remember anything 5 units or greater is a commercial property by definition. So these loans allow us to purchase these small commercial properties using the traditional DSCR programs that we have, which are amazing. So one option that you saw on the screen there is one of the options that Jose is going to go into. But since they're very specific, Jose is going to talk a little bit more about how we navigate these scenarios. So if you're ready there, Jose, let's have you go ahead and take over.
All right. Good morning, everybody. Thank you for joining us. Daily Rates Live with the Mortgage Calculator. Now, first thing I want to state is I want to differentiate property types because we have two similar programs. We have the mixed use 2 to 8, which is for a property that is at least 50.01% resident, which is at least 50.01% residential and no more than 49.99% commercial, right? So that's a good option there. But this program, and that's a great option, that program, right? We get a lot of traction with that one. But what we're talking about here is our residential only component for this type of transaction, which is all the units have to be residential in nature. They can be studios as long as they have a kitchen. There's going to be a minimum square foot size, probably somewhere around 400 or 500 square feet. I'd have to look into the guidelines, tell you exactly, but it is for properties that are residential, anywhere from 5 to 8 units. Now, this is a great option that we have because besides the amazing rates, right? As you're going to see, these rates are probably 2 to 3% lower than what you're going to be able to obtain for this product, for this property type, through your traditional commercial conduit, which was traditionally what was available, the only thing that was available for this property type. You got more than 1 to 4 unit is considered residential. So you can go to your residential non-QM agency, but 5 to 8 unit was considered commercial. So now with our DSCR hybrid product that we have here, remember the DSCR product is relatively new to the industry, to the residential lending industry. DSCR, which is an acronym for Debt Service Coverage Ratio, which is obtained by dividing the gross monthly rent by the housing expense, right? That's how you get that ratio. This was a product that was only available for commercial, but now it's transitioned over into the residential world. And then some of our conduits have opted to use it for 5 to 8 unit properties, and with pretty much the same guidelines, generally speaking, regarding how they treat properties with zip codes and locations, right? In a commercial loan, when you try to do this loan through a purely commercial conduit, the first thing they're going to ask you is, okay, what's the zip code? What's the address? They pop it into the database. They see the population density in the area, and they see other factors in the area, factors like crime and stuff like that, then normally you would not be able to use for residential lending. But for commercial lending, there's no holds barred on that. So they can strictly tell you it's not a good zip code, we're not going to do the loan. Strictly, regardless, you could have a DSCR of 2.0, 900 credit borrower, 30 properties under their belt, massive experience, and they're going to tell you, no, I'm sorry, we just aren't going to do it because we don't like the area. right? On the contrary, this option does not look at any of those factors because they're not allowed to do so. Lending laws prohibit them from discriminating in that way, right? And well, the only thing that is going to be of any concern, which would be of concern on any DSCR loan, is the property rural, right? If it's a rural type property, they're not, or if it's designated rural on the appraisal, they're not going to do it. You're out of gas there. But if it's not designated rural, then you're fine. So I have 3 purchase examples for you here at different credits. Now, mind you, the examples I'm putting here are with our best rate option and the one with the most streamlined underwriting. So this is amazing because, as you can see here, now this is maximum on these programs also, just so you know, they're, no matter which conduit, whether we choose this one or for whatever reason, one of the other ones that may allow lower credit score or whatever, this is the one with the lowest rates with the highest LTVs. I mean, they're all 75 max, but credit score basis is going to be the one with the best rates. And these rates here are actually, if you remember the DSCR rates that Nick just shared with you, some of these are actually lower than a 1-to-4 unit DSCR rate. It's lower than most of them actually, because look at right here, you have 8%, right, with a little bit just under 1% loan discount to buy down, and then you can buy that down to 7.625, and there's probably a little bit more buy down there to keep it in compliance. I just didn't take it all the way down. But the main thing I want you to note on this is just generally the LTV associated with the credit score, because the rates will vary on a daily basis, but just the rates here, so more or less where they're at, but mainly 75% LTV, 760 or above. Now, with a 680, and actually my title there, I didn't switch it. It's not 75%. It's 680 is 65%. So we have 65% LTV. You notice the pricing gets a little bit worse, but 65% LTV with a 680 is all you need. And that's a very good option as well, right? And then in between the 70 here, this is 70 with a 700. So 700 will get you a 70, and 720, I put 760 score, but 720 will get you a 75. 760 or above will give you the best pricing. 720 is going to have like a half a point hit, but you'll still get 75. And 700 will get you 70%. So still very good rates here. These are going to be better rates and better LTVs than what you will find on many purely commercial conduits for this program. And the cash out refis will have a 5% LTV reduction on these LTVs and rates that you saw here. We usually get very excited investors after they see this show. So I would tell our team out there to be on the lookout for some quote requests after today's show, because I have had a few files that have been originated after very excited investors see these amazing rates that they can get. And most of our investors out there are going to be, believe it or not, at a 720 or above, and they'll all qualify for the 75% LTV option.
All right, it looks like we have a couple questions here. Nick, if you want to pull up the questions there on the screen so that Jose can answer them. All right, so the question is, where does the down payment mainly come from in these deals?
Well, the down payment itself is going to come from checking or savings. We would have to see if there's, maybe you're asking, could gift funds be allowed? They may allow a little bit of gift funds, but they're not going to allow 20% gift or anything like that for the down payment. and gifts would not be allowed to cover any of the reserves. So, traditionally on these loans, you can't get too creative with seller credits either. Typically, they're going to be max 2% of the sales price for any seller credit on these deals. So, the majority of the money here is going to have to come from the borrower, from their savings, from their checking account.
All right, looks like we got another question here. The question from Jason is, are there any restrictions of use of these options? For example, can the borrower use units for short-term rental, long-term rental, assisted living, corporate housing, etc.?
Okay, that's a good question. Now that goes back to us structuring DSCR loans, right? We recently just had a training this week, two trainings on working with short-term rental investors. And if you recall that training, that training is completely applicable to this product, because actually the option that I was mentioning during that training that allowed the use of short-term rental revenue reports without an LTV adjustment, this is the DSCR option that I was talking about for the 1 to 4 and also for the 5 to 8. So short-term rental you can use to qualify the borrower. Obviously, long-term rental you can use to qualify the borrower. I'm not sure what MTR stands for, but assisted living, no, that's going to be a no-no, because that's corporate use of the property, right? If you are renting it to a company that does assisted living and all that kind of stuff, you're going to run into issues. So you would definitely want to check that out with your scenario desk before. But most of the scenarios I've run into with DSCR, with assisted living, if it's not a true corporate conduit, they're not going to accept that use for the property. Now, corporate housing, where you're talking, that's sort of like a type of short-term rental where you don't really have long-term rental leases. So I guess you could consider that similar to doing short-term rental. In the end, you're going to, in that type of a scenario, if you're obviously not going to have short-term rental revenue reports, you will probably have to qualify the property on the long-term rents, because you're not going to be able to use a corporate housing where there's no lease unless you have a master lease from a property manager that you could show the steady income stream that would be similar to long-term rent. You're going to have a property manager that is paying, and then the property manager is managing the corporate housing, collecting the money, paying out, keeping their cut. But and there may be additional monies paid out that could be covered in the lease. But no, assisted living definitely, and it's second time in 2 days that somebody brings up the assisted living facility question on DSCR. So that's a good point.
All right, I don't see any more questions, so I think we can wrap it up. Again, this is one of our most popular products here at the Mortgage Calculator. If you're an investor and want to get more info on this, you can visit us at themortgagecalculator.com or send us an email, info@themortgagecalculator.com. We can pair you up with one of our 320 loan officers that can guide you through and consult you through these different loan products. Remember that we do this show every day at 11 a.m. Eastern, every weekday, I guess I should say. So thank you all for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all on Monday for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone take care. Have a great weekend.
Thanks, everybody.